Thank you all for coming. Welcome to the session. This is a question and answer session, as the introduction says. So you, the attendees, are the ones who guide the session with your questions, with your requirements, with your doubts, anything that I may be of help related to technical analysis, related to trading, related to the Forex world. I'll be at your disposal during the next 45 minutes. So there is no specific topic prepared for this session. It's an open session to treat any topic, any subject that you may be considering right now in your trading, any specific tool, approach, or any doubt about methodology, and so on and so on. It's not so much an analysis session, although if required, we can go into analysis of current charts. But it's more for those people who are working on something, strategy, on the indicator. We have and you have questions about any of these topics, so that we might considering answering. And the approach or the perspective is always a technical one. Well, about harmonic patterns is not my specialty. I'm not very well versed in harmonic patterns. We have Derek Frey, who is a contributor of ours, who is a specialist in harmonic patterns, and I would suggest that you consider asking him. He's very frequently here with us with his webinar sessions already for many years, and his approach or his method is using harmonic patterns. So perhaps he's the ideal person to treat this topic. Gunster asks me, how do you find bias in your trading and make a plan to enter? This is an interesting question. Already the question itself shows already that there is a structured approach, or at least a wanting to approach the market in a methodic and structured way, because he asks about finding a bias and make a plan to enter. So it's anticipating that there has to be a bias or a plan before entering the market. I would maybe dissect the question and separate bias from a plan, because you may have a plan with a if-then scenario. Let's say if something happens, then the outcome or your action taken will be a determined one, and that is different from having a bias. I understand that we are as human beings is easily to be biased for a certain outcome. When we interpret reality, or when we interpret price action, we have the tendency to build a bias, to make an estimation, or to have a preferred direction for that price. It's going up, it's going down, it's going sideways, and it's easy to fall into a bias. But the bias is from a strategic approach has a danger, because it will, like the word says, it will suppose you have a preference for a certain action, for a certain direction, and you may not consider what the chart is technically informing you about, and or even distort what the chart is telling. So I would try to avoid formulating or building a bias, and instead building a plan. And a plan, as in when you analyze an instrument, usually a good analyst offers always a scenario to the upside and to the downside. That is an alternative scenario, at least to that bias or preferred direction or preferred outcome in the market. So in the same way, we would approach our trading from a strategical point of view. We would have always an alternative or alternate scenario in case our preferred scenario does not work. Okay, so much for the methodology. When talking here specifics, I may perhaps open the chart just to show for you, how we would approach. The first thing I would approach or build the plan starting with a higher time frame, okay, and going into lower ones, okay. And in the higher time frame, perhaps we can choose another pair. There was Sylvester was asking for the Kiwi dollar. Perhaps I can answer both questions by taking the Kiwi dollar. Let me, where I have it. 1 second. Okay, here. So I would start perhaps with a weekly chart, okay. And on the weekly chart, maybe we can delete all this stuff that we see here. And I start with a blank template, okay. Let's say I start with a weekly chart, okay. And initially, what the first approach would be to identify horizontal support and resistance levels. Okay, I give more importance to the horizontal ones because horizontal support and resistance levels is tied to a price or to a price range, while a dynamic one, a upwards or downwards sloping resistance or support level, is one made of many price points, so to say. Okay, so for humans, it's easily to think in single numbers and even more in round numbers. So we start with horizontal price ranges, and I prefer ranges to the single price or to lines on the chart. Okay, and therefore I simply insert ranges there where I see that a big imbalance in the supply and demand is seen on the chart. Okay, resistance is a place where this is a level above current price is resistance, and it's also a level where the supply is potentially higher than demand, or at least in the past it has been so. Okay. So we start by identifying these levels. There is not a need to go very much back in history when we analyze higher time frames chart, but you can. Okay, I will not do it here, just to save you some time. Okay, we see those levels that I marked on the weekly chart are well above and below the current level. So I would do the same. I would do the same again in this daily chart. Okay, so we see we have a resistance level starting here, and as a resistance, I have a set of criteria. I have a set of criteria before finding these levels, but the most significant levels are those where a V or a inverted V is built. That is a rise or a rally in price and a rejection of a certain level. Okay, or a fall, a dip in price and a rejection of a support. Okay, and this V or inverted V gives prints a level of imbalance that you can mark on your chart. Okay. Similarly, you start to build to make the same for lower levels. Okay, and it is interesting always to keep in mind what the levels that are most recent. Okay, because as you see here on the chart, recent or past support and resistance levels, they migrate. Okay, they are broken, and they may also migrate. Okay, like this level here represented a dominance of demand at this level, migrated to a lower level later on. Okay, and even here, some sessions after this manifestation here of imbalance, you got a revisiting of price to that range. Okay, so it's always worth working with ranges, especially in a market which is leveraged, like the forex over the counter market, because many support and resistance levels can be violated, and this represents a migration of the lines, a migration of the levels. Okay, so that is why we consider always the most recent, and those levels that are still with those with that latent or that potential imbalance. Okay, that carries still that potential imbalance. We are here on the daily chart, so I would go lower still. Okay, here we are on the 4-hour now, and I would keep doing the same. Okay, insert, for instance, here another level. Okay, and we can move back in force. See here, for instance, we are again on the weekly. Okay, let's see how it looks like, and we see here the ranges that I've just drawn where we are. Okay, and going back to higher time frames is somehow useful, because we then can see how these different levels, how close they are to each other. Okay, if I find a level that is quite close to another, I may think of deleting this level and consider the one from the higher time frame. Okay. Once I have the horizontal levels drawn on a chart, then we may start constructing diagonal levels. Okay, dynamic levels. For dynamic levels, there is always a question whether to take the bodies or the open close range, or the high low for the period. And there is no strict rule for that, and you will see different experts, different analysts use different methods. I would suggest to fit the line where most of the rejections of that diagonal level are more significant. At times it may be the real body of the candle. At other times it may be just a shadow or a spike in the bar and in the candle. Okay. For instance, this group of candles here, we see that the close and open prices are reacting quite well to a line that just barely touched this spike low here. Okay, and once you start to draw the line, you also, it's also interesting to search for channels by searching if there is a parallel line that you can fit into the price action. Okay, sometimes there isn't, so you abandon the idea of establishing a channel, but it's always worth to try to find channels or eventually potential channels where you don't have all the points needed to draw a channel that is at least 2 support and 2 resistance points, but maybe you may have two supports and 1 resistance, and you can just draw that parallel line up to that resistance, forming a potential channel which is not yet visible on the chart, but maybe so in the future. Okay, and this works on all time frames. So, for instance, here we may have here a new downward channel in the making. Okay, especially if this upward sloping line is breached. Okay, so as you see, we can do the same with the lines. We can do the same and delving into smaller worlds to see if there is anything meaningful. Okay, with diagonal or dynamic trend lines, I would be more careful not to crowd the chart with these levels, and especially because what we want with this first approach, and I'm still answering the question from Gunster in regards to the methodology to make a plan before entering the market. I would not crowd the chart with too many lines, because this is an initial approach. This is simply a support and resistance analysis. Once you get these levels on your chart, you already see those areas where you may not find any significant support and resistance. Like, for instance, here below this recent support on the 4-hour, you may see there is empty space here before finding this line. You may also search for levels, for instance, where this movement started. And you may search for confluences between these horizontal levels and the dynamic ones. Okay, here's where you start to find confluence points. Okay, let's see what happened here by going perhaps into the daily, and here we are, and we see, in fact, there is some play here between sellers and buyers, and we see a pullback to a level which we may draw the range to this level. We see initially here a resistance, a break of resistance, and a retest of the new support. So that led us with a level here, which we may consider then later when this level becomes confluence with that line. Okay, so we may mark this level on the chart. Okay, somehow, so that we consider this point is important, and we may even establish a price time coordinate, for instance, and here we have a date. We can find out about timing, okay? Because if we find a specific uh, uh, cross between horizontal and a dynamic level, we have also the time coordinate, right? So we can estimate how long a certain movement may last. Okay. So also this the crosses of lines are important. Okay. Also the crosses of line are important in terms of timing, because many times, especially in higher time frames, the crossover points between levels are turning points. Okay, are turning points, or at least decision points. So this would be the initial approach, just to consider not entry or exit levels as such, but to consider areas where I may have no obstacles in between. Okay, areas where I can travel, knowing that I will not find a lot of obstacle in the way. Okay, and that is why I start in higher time frames, go into lower ones, and once I have identified these areas, which are normally blank areas on my chart, and also eventually some confluences points as for the timing, then I would switch, and here is a new chart, to a trading model. Okay, here is already a chart which is where I use a specific system. Okay, a set of rules, and here I have the same chart as I see here on the right. I have it on the left with my indicators. Okay, because when you trade based on rules, on fixed rules, obviously the rules are made to print buy and sell orders, right? To trigger buy and sell signals. But having such a previous analysis on support and resistance, on areas which are better to travel in between, allows you to filter discretionally those signals which are not in synchrony with what is happening in the market in terms of support and resistance, in terms of supply and demand. Okay. That is why I always have two charts, one with the very basic support and resistance analysis, and another one with the system rules, so to say, where I have the specific indicators, and where I find my signals. Okay, and once I have a signal, I just want to be sure that I have I'm not running against the wall. I have no obstacles in front of me, and if ideally I want to have some obstacle behind me, something that I can say, okay, if price turns against me, then the obstacle which is behind me is my stop, is the point where I abandon that idea. Okay, it's the same. We can imagine a wall, for instance, and if I want to push someone and I have a wall behind, I can use the wall as a start for making that push forward. Okay, and if that person is stronger or heavier than me, he will push against me, and the wall would be the stop point, the point where I could not go back anymore, because there is a wall. So these levels would be those walls. Ideally, I want to find, obviously, sell signals close to a resistance, okay, close to a level where I expect supply to manifest, and ideally I want also to find buy signals when I'm close to a demand level, to a support level. Okay, because that wall will give me some confidence as for the level where I would abandon the idea. I want that level to be close to me. I want the stop to be close to me, much closer than my target. Okay, and with such approach, and without entering into specifics about the strategy, with such approach, we can start slowly to build a method which is rather of positive of negative feedback instead of positive feedback. Positive feedback traders are those that buy into strengths, that is, price is rising, and the investors enter the market. The traders buy because they see that the price is rising. By buying that market, they contribute to further rise in price up to a certain point, obviously, but that carries an enormous amount of risk. Instead, a negative feedback trader would rather wait for that exuberant move to reverse and enter at levels which show some momentary exhaustion, taking into account what is the stronger trend on a higher time frame. Obviously, we want to profit from some trend, but we don't want to run against what price is doing. Okay, and we don't want also to chase price and buy the market close to a resistance or sell the market into a support level. Okay, that would be positive feedback trading, which is maybe it worked in the past when technical analysis was not known, but nowadays it's you can do it, but you would have to support a big amount of risk and have a lot of patience to see prices going into your direction. Okay. Let me, Boyki, sorry. I will switch the question. I think I've answered more or less the questions above. Boyki asks, horizontal support and resistance become each other, but why do diagonal support and resistance manage to become each other? Well, the diagonal support and resistance, like any drawing tool that we have on a chart, we must keep in mind that any line that we see on the chart does not exist. In fact, okay, there is when we close our trading stations, there is no little man that during night when we sleep they put on the lines on the chart and they work that level. So in reality, lines does not exist. This is simply a representation, okay, on a chart. In the actual negotiation in the market, the line does not exist anywhere. Does not exist in an exchange. Does not exist in an OTC market. It's just a representation, a charting tool that we use on our charts. Okay, so that is an obvious observation. You all know that, but when we are under a stress situation, we may think that because there is a line or because there is a certificate or a certificate is doing something, that the outcome must be a certain one. Okay, we become, again, we are overcome by bias, and we start to think in linear process. Because price is doing that, then the outcome has to be that one. Totally forgetting that what we are seeing on a chart is not a representation, but it is reality, and it's not reality. Okay, it's just a fragment of reality, and it's just a reduction of all the information that reality contains. It is impossible for us to interpret reality in the full amount of information that arrives to our senses. So somehow we have to reduce that amount of information. The charts do that, and indicators do that. They reduce the amount of information which is within prices, and they display that reduction of information in a certain way to pick a specific perspective, or to evidence a specific threat of that reality, or that reduction of reality, in fact, which is price. Because price itself, the price series, is in itself a reduction of reality. Reality in that case being the negotiation between buyers and sellers. Okay, and as such, and not wanting to go too far here from your question, but the same dynamics that we see with horizontal levels, we would expect in diagonal ones. The answer for that is, I don't know if there is an answer. I tell you that because even in random outcomes, you may observe the formation of those lines, of those diagonal lines, of channels, and there is random price or quasi-random, so there is no one negotiating, and still you have head and shoulders built in a reality where no human intervention took place. How is that a head and shoulder is forming from a random series of data? So really, the true answer why they become important or significant, or why price reacts to those levels, the full answer I couldn't give you. But the truth is that anything that you draw on a chart, you can be sure that thousands of other people are seeing. Okay, and so if you, and the more evident the pattern that you are seeing on a chart, the more people are looking into it. Okay, so there is nothing original. We may think initially when we start our career in trading that we find some pattern here and there, and but we can be sure that, like us, thousands of people are looking to the same. Okay, in that sense, it's interesting to have our lines drawn on a chart to see what others are seeing and thinking in terms of what would I do if I would be right now in a position, or if I am in a position right now, what would I do if I would be not in a position? So thinking conversely to what we are doing, thinking in the other party. If you are going to buy, thinking who is going to sell to me, okay, and what reasons the other party may have, okay, to sell to me if I want to buy at a certain level. Always think in the opposed perspective. Okay. And as for the role of support and resistance and why support and resistance turns into each other, when we talk, let's go back here to this example here that we saw on was it on the daily, or here? This is a dynamic that we see very often. a resistance level, which shows some reaction, like we have here, this small retracement after this resistance, a break of the level, and then a retest of the level. Okay, like this, it would make this S, or you see this zigzag action here around the level. Okay, these levels show a certain dynamic. People that took there are people who took action here by leaving the market. Others that wrongly bought at the high level. Those who bought here, which were eventually doing some money when there was the ensuing breakout, just went out of the initial position when prices came back to their break-even point. Okay, we may think of that. We may think also of those who took position here on the pullback, just wanted to wait for a less risky position and waited for those perhaps scalpers, let's say, who broke the level initially and took some profits shortly thereafter. Okay, by taking profits, the price just falls to the level where there is demand. Okay, so it's not that there is some selling here, but it may be just because there was no buying there. The buying was located here. Okay, it's important to see that when prices rise and fall, it's not always due to the fact that there is buying or selling. It's the difference between buyers and sellers which prints movement. Sometimes we see a price rising very fast, and we may feel tempted to buy, to jump into that trend, but maybe that trend is not made of buying force, but of lacking of sell force. Okay, if there are no sellers at a certain level, if sellers say, okay, I'm a seller, but I want to sell up here. Okay, I want to sell up here. I don't want to sell here. So prices will inevitably go very fast up to that level where the seller is. And if we would have the chance to see within a candlestick or a bar, what is happening, a thick bar, like let's take a thick bar like that one here, for instance. Where was I? 1 second. Let's imagine a thick bar like that one here. Yeah. This is there is a solid body in this candle. Yeah. But perhaps the negotiations that took place during this period. Okay, this is a day. Okay, this is perhaps not the best time frame to show, but imagine this is a shorter time frame. The negotiations that took place during the body of this candle are not equally distributed. We may have segments of the candle which are void, which are vacuum. There are gaps. There was no negotiation at these levels. There was no negotiation because sellers were just going up and up. They wanted to sell, okay, but they wanted to sell at higher levels. So price jumps to the next seller who is above, and jumps and jumps and jumps. And finally, you have a candlestick, a solid body on your chart, which by looking into something like that live, you may feel tempted to join the trend because you see, wow, those who bought below here at the entry level are making good money. But there are not many people who bought there because it's made of vacuum. All the way up, it's made of vacuum. Yeah. Yeah, for instance, a Marabuzo candle. This is not a Marabuzo. A Marabuzo would have no wicks. Yeah, the ideal one. But a Marabuzo candle may be made of vacuums, like on an airplane. When the feeling you have on an airplane when when there are these, I don't know how it is called in English, but these holes where you have where we feel this falling, yeah, the vacuum idea. This the same would be on inside a candle. A candle, in fact, is just a representation. It's not the reality, which is the negotiation, right? Air pockets, yeah, genau. Air pockets, yeah, exactly. Okay. Solomon asks, anyone knows how to block pop-up ad page for of exchange brokers? I'm afraid there isn't. I think you mentioned the first when you first enter the website. I think you can't block that page, but it just happens one time. If you enter the page for a second time during the same day, you will not find that ad page, I think. Solomon asks, what if you have moving averages in the empty areas? That is an interesting question. So we were initially here with the Kiwi dollar. Okay, we had these empty areas. Okay, and the next step would be obviously to jump into our trading model. Okay, and look there into confluences of the indicators that I'm using in my strategy that I have tested independently of any support and resistance analysis. I have tested my hypothesis, and I could verify that there is a positive outcome. There is some robustness into that strategy that I wish to enhance with an additional analysis, with a more discretional approach. That is why I do the support and resistance analysis. But I already use an analysis which I have tested on on itself without that extra layer of discretion, and I want to look for confluences between my levels, which I'm using, moving averages, pivot levels, weekly, daily pivot levels, whatever. I want to look for confluences between these levels, which are levels that also many other analysts and traders are looking at. Okay, perhaps not the same combination or the same rules that I'm using, but the levels these are levels that many others are looking at. I want to search for confluences between these levels and those levels that I found in the support and resistance analysis. Okay, and I want to take seriously those levels where there is a confluence at least of three technical levels into one price range. Okay, if there is a single, let's say a R1 or R2 level from the daily pivot, let's jump into here. We see here on this chart. Okay, we have these levels which are S1. You see this one is the daily pivot. This is S1. This is S2. Okay, this is S3, and I want to see if there is some confluence between these levels and previous levels. Okay. Okay. I want also to make use of any other tools that provide me with some additional information for confluence. For instance, someone asked before fib levels. Richard asked for fib levels. The same. They would be interpreted the same way, the support and resistance, and if they are confluent with other levels, where you have a cluster of levels, you may think that if you have a cluster of levels means there are many more people looking to those levels than a level where there is just one indicator. Okay, because people are looking at the same indicators as you are. So if there is a cluster of indicators, and if price is running fast against a cluster, and here is one of the keys that I use. If price is running fast against a cluster, and that running fast is a retracement of a bigger trend. You may have an overbought or oversold market, okay, in the opposite direction to a main trend, yes, and running against a demand or supply level. Okay, imagine you are in an uptrend. Okay, let's see if we can find it here on the 4-hour. For instance, here, let's go here to the 4-hour. Okay, we have this dominant downtrend here. Okay, and during this dominant downtrend, I see some brief pauses where price took some time to recover and moving forward. Okay, so imagine I'm down here now. I'm down here, and I saw all these price going down. Okay, it's an overstretched market, exuberant to the downside, and I want to join that perhaps new trend. So I wait for this retracement, and in terms of a systematic approach, okay, I want to see this down movement here. I want to see what happens when the price retraces after such an impulsive move. Okay, and perhaps I have to go into a deeper world here, like the 1-hour. Yeah. And see what happens here to these levels. I go to 1-hour. Okay. This would be this level here. And I want to find out if in my model I have a signal around this level. Okay. And and specifically here in my approach, I would have a first sell order on this level here, a second one here, and a third one here. Perhaps I would have taken action at this cluster here. Yeah. But this is already going into too much specifics. But the idea is that, okay, I want to see some exuberance, initial impulsive, and then an exuberance, like a retracement with the same character of overbought or oversold into a level where previously there was some dominance of the demand or supply, depending on the direction of the trend. And once I identify these levels, I jump into a specific combination of rules, and I take action only in close to those levels. So I don't take any signal. Trader Red asks, all of the technical analysis you do, what do you consider your holy grail number one thing? I would say in technical analysis, the concept that I must pay attention to and I try to cultivate is the principle of confluence. Is the principle of confluence. Yeah. And the other thing, which in fact is could be considered technical analysis, since it's the academic backbone of technical analysis, which is behavioral finance. And in behavioral finance, I would consider perhaps all the aspects, structural, cultural, and psychological aspects which are which happen or occur in exuberant situations, in exuberant market situations. I would consider those as also a priority in the sense that it helps me to shape a mindset which is makes my thinking a bit different from the majority, considering all those aspects that influence the majority to do certain things, and this can be different origin. It can be structural, market structural aspects. It can be cultural, beliefs that are widespread beliefs, or specific psychological aspects, the way we deal with risk, the way we deal with profits, and so on. This is a topic for itself. We could go further into developing this, but perhaps to answer your question, I think these two things are. Yeah. I would like to research more the timing aspect, the timing aspect of markets, but there I'm still working on it. I have no clear tools or methodology as for the timing, but I think if you can figure that out, it's a huge. You can make a huge differentiation. Yeah. And then on beyond technical analysis, or belonging also to technical analysis somehow, is the position size, the management of position size, which I think it's also undervalued. You can take a mediocre approach or system. You can enhance it considerably by managing well your position size. You know, I think I've seen many people who started to make a difference in their trading upon the implementation of a specific money management strategy. Yeah. People using systems very basic, using indicators or setups which the majority are looking at. So no differentiation at this level, but they are making something different. They are managing their bet sizes very systematically, and therefore they win. Okay. We had, for instance, in our house here at FX3, Tony Jost, who is a great trader in that sense, that he had a very specific way to manage his position size. There is somewhere, I think, in the ITC recordings, there is a recording of his speech in the first ITC, the International Traders Conference, that we did, and you can look there for the details of his approach. And if not, under the Learning Center, if you go to Unit C, where we talk about position sizing, there are several methods of position size. I think it's very interesting that you have a look to that, because usually when we talk about position sizing, we talk about the fixed fraction method, and this is just one. There are many other methods to use in forex. So I would suggest you to have a read there, and to Learning Center, Unit C, money management section. You have 4 or 5 different methods deployed there with formulas and everything. Richard says timing is something I would like to learn more of. Yeah, definitely. And I think timing is crucial. Therefore, we can, as for timings, we can speak of cycle theory. We can speak of seasonalities. We can speak of astrofinance, moon cycles, and so on. We can speak of GAN. Okay, so there are different ways, combinations that moon cycles. Gan Fibonacci, yeah. Mhm. Well, there is. I mean, there are people incorporating martingale type of position sizing based on martingale approach, but but I believe also that you have to put a stop to the martingale. I mean, you can increase your bet size once a loss happens, especially if combined with a mean reversion approach. You are if you start entering the market when there is an exuberant move and you start to capitalize on a regression back to a mean, at certain point this regression will happen, right? But in a very impulsive market, this regression may be of very little value in terms of points gained in the market. So and the price can also continue to go against you for a longer period than expected. And there is where I think that that you should probably establish a stop to or a limit to the deployment of the martingale approach. But it's mathematically it's true that a martingale approach uh, used in a pure sense of it would require an infinite amount of capital to trade it, because the longer you are in the market, the more trades you do, the larger, mathematically speaking, the larger can be the the the, the consecutive number of losing trades, right? But usually that is not the case. At some point, you have a winning trade. Especially, I repeat, if you are not betting just for the sake of betting, but you are deploying a tested strategy, and this strategy is especially a mean reversion one. Okay, something that you know that would probably anx you because prices have to return to an historical mean at some point. Okay, the imbalance between buyers and sellers at some point becomes so huge that there are no more sellers or no more buyers, and the price changes its way. What happened with the euro in January, where we were all sellers and we were all pessimists. COT levels were at records, net sellers, and price changed. There was no. However, we have the weekly forecast report here at FX Street with some of our experts participating, and also some of the internal experts of FX Street. And at that time, I'm just doing a statistical study of that report. At that time, we were there was no disparity in the results in the forecast values. We were all bearish, yeah? And prices changed direction because we were all sellers. There were no more buyers. Okay, so prices have at some points to revert back to a mean, and if you combine this with a martingale approach, you may succeed. Obviously, at least I have seen quite many professional traders working with martingale approach, and you can easily see if you once you see a equity curve and you see the equity curve based on such a martingale approach is you can usually see it's inverted correlated to impulsive or trend movements in the market, and usually when the market reverts, they report gains. So and there are CTAs working with with martingale approach as well. So, and the one I mentioned here from Tony Jules is not a martingale approach, but it's not a pure martingale, but it's not an anti-martingale neither. So he established a limit of 3 entries per situation, per setup, and he had initially what he said, okay, I will martingale, but I have a limit of capital that I will deploy into this setup, okay, and specifically into 3 trades per position. Okay. I hope I answered the question. Let me see if there is any question above that I forgot. Have you covered the support and resistance levels for euro? Well, let me see for euro. I've been a few days or a week or so away from, a few days only from the market, so I have here a few levels on euro. Yeah, these are the levels I have. I'm expecting to see the reaction here at around 33.20 or something like that, to see what kind of reaction there is in the euro in that area. There is also 2 Fibonacci levels before 33, just before. So that area, I want to see what happens here. Ideally, we would run into that wall with some speed. That would be ideal. As for the downside, well, I think demand located at this level here. I don't know if it doesn't seem that demand was picked here. I would investigate what happened specifically here, what happened here, and what happened in other pairs at this area. This is something also interesting to see when you analyze support and resistance, to verify those imbalance levels in terms of time when they happen, and see if they are confluent with other majors, with other pairs. What happened at that time, precise time moment in other pairs, okay, and see how that expression of imbalance looks like in other pairs. Yeah. I would have not much to say right now here, since I've spent a few days off the markets. I'm just holding here to this template, to this situation. Let me see if there are any other questions above. Moving averages, we already. Richard said before that finding the candle body is far better to represent horizontal resistance and support, as I can see clearer when a level has been clearly breached. Yeah. Although there is no rule for that, but I agree. Yeah. Okay. Do you consider fundamentals and news and data releases? Yeah, Boyke, I think you already asked me this question some months back, and the fact is that I'm a technical trader in the sense that my school is the MTA, Market Technician Association, and the further we go into fundamentals with technical analysis studies is intermarket analysis. And in intermarket analysis, yeah, I do consider some correlations. Some lectures in terms of support and resistances are happening in other markets as for risk appetite, risk aversion, Yeah, so I look to technical situations in other markets and in other indicators, but I do not consider fundamentals in the sense of fundamental releases as such. I have no systematic approach to act on these data releases. Okay, I do want to consider obviously when the data is released, because when you work with confluences in terms of horizontal, diagonal, in time, you will many times see that the market will work its way out into a certain confluence where the time factor is also important, and that time factor many times is confluent with a certain release. So the market anticipates that release, is waiting for that release, and if the market wants to sell it at that level or expects to sell at that level, so it will not trade into that level too early, because it will then have to sell before the event. Okay? So many times you find the interesting point that data releases are interestingly announced when you have a confluence level on your chart, and there is no magic about it. It's something that when you expect something, when we expect a price development, we expect also we have also expectation in terms of time. I expect this to happen tomorrow, in 2 days, or a week after. So it's also interesting to see to know when this data is released, and if that fits into our timing models. Yeah. If Gunther asks if I use fifth time zone clusters for timing, no. As I said, I'm still very young in terms of timing strategies, so I don't have any big experience yet. It's something that I'm working on. Okay. And as for news, you know that we are a news producer here at FX Street. We hunt for news, we produce news, and I'm always, as a trader, very cautious about what kind of news are being produced, because if you're a news producer, you have somehow to say what the majority of the market participants want to hear. Yeah. In January, would you have talked about positive aspects on the eurozone? Yeah. People would laugh at you. You know, why are we talking positive if we are all bearish? We are all selling like crazy. So, but the price reversed, and quite much. So with news, it's more interesting than the news itself is how the news are supporting the market's participant mood, so to say, and find those points where you can appreciate some change in the mood, some change in the risk appetite. Okay. And yeah, I'm getting a bit tired. Maybe if there is no more question, I would call it a day. Let's see if next time I'm working on a statistical study right now based on the weekly forecast report that hopefully I can present to you in a webinar format, and we would do a webinar about descriptive statistics and also inferential statistics. I think this is a topic that has not been covered yet here, and would be perhaps interesting, just how to approach a series of values, a series of data, be it a time series, a price, or any survey that you do in your local area or something. The approach is the same. The approach is the same. It's descriptive statistics in terms of central tendency, of distribution, of correlation, of linear regression. I think a lot of things can be discovered, and also in intermarket relationship. That Boyke asked me about consider fundamentals. There is something that is not very much considered, which is intermarket analysis. That area which is the frontier between fundamental and technical. You treat fundamental data technically, and there is a lot to discover. There's a lot to discover. How, for instance, if you see a trend in gold, you see a trend in gold, but gold is priced in dollar. So is that trend also enforced if you quote the gold in euro, or if you quote gold in yen? Okay, so there is a difference. If there is a generalized trend, if gold is trending in all currencies, means there is a real trend. If gold is only trending in one currency, so maybe there is some market manipulation, right? And such treatment. Okay. Yeah, I need a cup of tea. Okay, we can call it a day. Thank you very much for your very interesting questions, for your participation, for your patience to be for almost 1.5 hours here with me. I hope we learned something. I put some ideas together. For me, it was also a learning session somehow. And any questions that you still may have, maybe you are timid and you didn't want to write down your question here, or you were not inspired, no problem. And here we have my email. You can write to me with any questions. If you have an idea for a webinar, something that you want me to explain in detail. And hope to see you soon again. Bye bye. Thank you.